In today's video, I'm going to talk about a dirty little secret within the trading industry, and one that many companies go out of their way to hide or discourage through insane fees. The market calls this technique reverse trading. Now, before I really get in depth into this, I want to first make it very clear that taking a hard loss on an asset is a choice, and sometimes it can be the best choice you make with an asset. This technique is not meant to disparage that choice or the necessity of that choice. This technique is just that, one approach for recovery. It has its place in your tool chest like any other technique. From the standpoint of the individual choices you need to make as a trader, there is no right or wrong when it comes to taking hard losses or thinking about how to deal with situations where a position is severely underwater. Only you can make those choices based upon your personal risk assessment, financial situation, and other factors as a part of your risk mitigation. Now, for this technique, it's often discouraged, and people try to browbeat anybody down that uses it, because it has some very distinct advantages. The technique is called reverse trading, and it has a very strong set of rules that must be followed in order for it to work properly. If you don't follow these rules properly, it can be a hot mess. Because of the difficulty of using this technique, most of the time you can only use it manually. Very few platforms allow automation of this technique, and they all hinge around one very critical point. When you purchase a position versus when you sell a position, most platforms expect that value to be the same. For reverse trading, though, that value must be different. That is, you must be able to sell more than you purchase. Now, that defies logic in a way, because from the standpoint of the exchange, you can't sell more than you purchase unless you already own it. That is the secret that nobody wants to talk about in the industry. The dirty little secret of reverse trading is, as long as you have not blown your budget and you have taken proper care of your budget, you can trade out of a negative position, one trade at a time. That is what today's video is going to discuss. Using reverse trading to literally trade out of a negative position. It's a technique that, with practice, will give you one more tool in your tool chest to keep you one step above the market. Now, to proceed with why do most exchanges or most trading platforms not allow it? The answer to this is simple and can be easily seen with the number of losses that occur with each market dip. They know people are simply going to take hard losses because putting this technique into practice takes a lot of work in most cases. In fact, right now there are only 2 platforms I know that support it directly. FrostyBot and the new TradingView Alerts Processor, or TAP, as both of them let you set a position size for buying differently than the position size for selling. Even TradingView's own strategy system mandates that your position size must be the same for buying or selling unless you specially code your script to allow it otherwise. And that can be tedious and tricky. And that's why they know this technique won't be used very often. And in some cases, one particular exchange comes to mind that has set its fees to 1% to help discourage anybody from using this technique, because the amount of money that you're going to make during the recovery process may not compensate for the insane fees they charge. Which brings us to, why would any legitimate exchange want to block this? What is it that they gain by you taking a hard loss? That gets into what some would describe as insider trading or stop loss harvesting, or any other words that describe a market manipulation technique of the exchanges working with large institutionals. Retail traders are pretty much bait, and they are used as bait, and many exchanges with higher fees make it clear that the retail trader is nothing more but bait. In fact, Coinbase has made it clear the reason they charge higher prices on their fees is to keep your money longer in the trade. Increasing your exposure increases your risk. By keeping your money longer in a trade, not only do they profit from you potentially losing, they profit from a fee of you winning, and they profit from interest on your account because you've had to hold your money in the position longer to make a profit for yourself. So as you can see, Coinbase literally has its investors 3 ways, and it's found a way to take advantage of forcing them to keep longer exposures. This type of an approach lets you move in and out of trading, and you can reset a bad market by starting at the bottom anytime you need to. Reverse trading works on the principle of being able to buy and sell like you normally do, but because you are using a position size of selling larger than your position size of buying, you are able to slowly work down your existing negative position. Now let's get into the details of how to trade in reverse or trade backwards. That is very simple. Let's start with a position I have, EOS. I have a cost of $166 in this position, and right now it sits at a loss of $33.29. In essence, if I was to sell this asset and get out, I would lose $55. Now, as I said, your position size for buying and selling need to be different. So I'm going to maintain my position size of $11, and I'm going to sell $12 every time I make a 2% profit. Now I've broken this down to make it easy so that you can see how the weights of the positions play out when I go to sell. Here is my $11 position. My profit, 2%. That gives me 22 cents value. The weight of my selling is 92%. So 92% of my selling value is my original $11 position. That gives me an amount of 2017, basically 2 cents. Now, I'm going to take $1 from my loss. That's at a 33% loss. The value of my loss is roughly 3 cents. But the weight of my loss in relation to my selling size is only 8%. So the weight is 2 cents versus 20 cents. So my average profit for this trade is going to be 11 cents. So for every time I trade using this approach, I'm going to make 11 cents, basically 1/2 of my take profit, or 1%. I am sacrificing 1% to trade backwards. Now my fees are 0.5%, so I'm still making a profit. I am still trading down my loss. So after 480 times, give or take any changes, I will literally have traded out of this loss at 11 cents at a time. So as you can see, this approach gives me a way that I'm not taking a hard loss. But I have to be able to trade more positions. I cannot have used all of my budget. And in this case, because I have such a limited budget on this account to begin with, I actually sold 25% of it at a loss. So this is the cost of what I have remaining after I took a 25% loss to free up space. So as you can see, this approach will let me reset. And let's change this to $300. So now, $300, 33% loss, I've lost $99. Using a buying position of 11, a selling position of 12, with a take profit of 2%. The amount here doesn't change, of course, because I haven't changed any of this. But it shows, and I can calculate the number of trades required at 11 cents. So, over the 871 trades, taking 11 cents off at a time, I will slowly trade out of this situation. Now, this is using the exact same recipe that I used to begin with. Nothing changes except your selling value. Everything else is exactly the same. And let's say the market takes another hard drop. Well, if your market drops again, say you've added $400. Well, now you see the number of trades on the basis of $400. But your recipe still keeps working as long as you have enough budget to continue making the purchases. Reverse trading is a way to trade out of a problem. as long as you have room to trade. If you do need to take a loss, you don't need to take a total loss. Also, reverse trading lets you trade out of your underwater position, but at the same time can still allow the market to recover, so that you might not take any loss at all. But it does require an asset worth trading on. If you have a poor quality asset, this may become more of a burden than it's worth. So you need to be sure to research your asset and only use this technique on reliably good assets. For example, using it on an asset like Beam could only cost you more money in the long run, even though you are winning trades time and time again. You don't want to get into a situation where the asset reaches a certain point that it becomes a problem. So using it on ADA or BTC or coins that are historically shown to be reliable in recovery is a good idea. Using it on coins like Beam, Civic, or coins that have a very tumultuous history is a bad idea. Now, there is a technique of using this all the time, and that is you seed your position with, say, $50. So you automatically start out at a loss, no matter what the market is. You make sure you always have $50, and you reverse trade at all times. BNB is a good coin to do this on because of its extreme highs and low swings. Every time it swings low, you reset and you start over at the bottom, trading backwards or reverse trading it. So it is a good coin to run this recipe on all the time. And in fact, a lot of investors do this consistently, where they don't care when they get in the market, because they always know by using this technique they'll make a reasonable profit trading backwards. So this technique can be used as a default method. It can also be used as an emergency recovery method. It has its points in both. Let's now start with the basic recipe equations I use for this chart. So basically the cost, this is how much you're underwater. What is your loss? Right here. So let's say we are a loss of, or excuse me, what is your actual cost? Well, our actual cost is 167. Now, how much did you lose? Let's put this up to 37%. This is just a simple equation. As you can see here, this is the equation. It's just a cost times the percentage. Position buy, just a number. Position sell, just a number. Profit, just a number. Now here, this is just your position buy. This is your position sell minus your position buy. These have to be different. If they're the same, you'll be under the amount of your fees. You'll never profit. This is your percentage loss. This is your percentage take profit. These values are simply the position times the percentage. And now the weight is simply the purchase price divided by the selling price. Purchase price divided by the selling price. And finally, the amount of your profit is simply going to be the value that you're going to make for your profit multiplied by your weight. And this is just an average of the amounts. So now we have $61 remaining. This is just a copy of this up here. We have the profit average, and then we simply divide the remaining amount by the profit to get the number of trades necessary to pay this back. Now, it's important to understand I am not counting the position size. The position size adds no value to the payoff amount. That's just the vehicle to make the profit. But let's see what happens if I take this to $11. I make it the same. Notice it is simply 11 cents. 11 cents is 1%. Now, if you take 0.5% off, and you'll notice nothing out of the original position. So you're making a profit, but you're not decreasing what you've lost. That's why you have to have a selling value higher than your buying value. You need to be able to decrease this amount. And 11 cents, yes, it's good, but it doesn't do what it's supposed to do. Now, if you go too high, let's say we go 13. Notice it gives your position here more weight. That means less value. Because when you figure out the mathematics, the more weight your negative position has, the more impact it's going to have on the total trading volume. Now let's say we step up to $20 positions. Well, now our position size for our negative part is less. That gives us more profit. That cuts down the number of trades. So there are a multitude of ways that you can do this, but always keep your selling price $1 above your buying price as a reasonable point. Once you figure out your ratios, then you can decide how to balance it. But you don't want this percentage going too high. The higher you go here, the less impact you'll have on your recovery. So, from my perspective, for 11 is always my trading value. I prefer a $12 selling position. Now remember, your platform must support position sizes from purchases and sales that are different. Platforms like Cryptohopper or 3 Commas do not. If you use those platforms, you must use this technique manually. If you use FrostyBot or Tap, then this technique is automatic. If you use TradingView connected directly to your broker through its strategy engine, you will have to use this technique manually, because TradingView does not allow the broker to have different values unless you explicitly handwrite the code necessary to handle that. And that is not realistic in most cases for many people. So always be sure you follow the rules of this situation. Your purchase position must be less than your selling position. You don't need to change your recipe. And if the market does drop, generally speaking, wait for it to settle, reset your values. Let's say here I have 167. Let's say the market, let's say the market drops to 45%. I wait for it to settle. I restart it with the timekeeper. I get back in at the bottom. I keep going. And I slowly work it down while I keep track of what I've actually recovered. That is going to be the best approach to this situation. Don't let this intimidate you because it's not difficult. It just takes practice and keeping track of your numbers. And the mathematics, the way I've set them up here, are fairly simplistic. So you don't need to really go into a lot of heavy details. Don't be overloaded thinking a hard sell at a loss is the only way to recover. It's not. It may be the best way for a situation, but 9 out of 10 times, it's not your only option. Reverse trading is a way, either as a common trading technique or as a recovery technique, of working against the market when the market is working against you. The mathematics are simple. The technique is simple. It's just a matter of practice. Until next time.